Well, good day. David Scott here, market analyst at City Index Australia, just covering the APAC region. Thank you so much for joining me today. It's a pretty wild time out there, so I know that time is precious at this point. So I'll try and be really succinct and to the point right now. Just looking across markets, of course, we woke up in Asia to news that largest declines in the S&P 500 and NASDAQ since December of 2022. That's ominous because when you see big declines in magnitude of 2% plus, you generally see multiple occasions. You don't just see one. So we can expect that we're going to see some turbulence there. We're at a turning point in the cycle potentially. Are we going to see a soft landing or are we going to see a hard landing? That's the question that the market is grappling with right now, which generally will go and lead to volatility across not only the stock market, but also other markets in general. In the podcast, or in the webinar today, I'm going to go look at a variety of different areas. I want to touch on China as well. We've just seen the medium-term lending facility rate cut by 20 basis points. A big cut, more than what we'd seen in the 7-day reverse repo and loan prime rates earlier this week. Again, just feeding into this concern about what we're seeing in the Chinese economy right now, which is definitely having an impact, particularly on those markets really closely aligned with the Chinese economic performance. Beyond that, I want to discuss what's going on in the US as well, because that seems to get a lot of attention right now. Potentially, are we going to see a recession? Bill Dudley, the New York Fed president, the former president, out overnight, talking about potential that the Fed needs to go and cut as soon as next week's FOMC meeting. Really starting to go and get people kind of alert to the potential that, hey, that maybe is something that out there that we don't know about. And you can see again, markets are getting a little bit anxious about that. Also, we'll have to go and touch upon what's going on in the NASDAQ and US equities more broadly. You have a look at a technical look at some of that, along with what's going on in the Aussie and some other markets out there as well. I will go and leave a short gap at the end there to go and offer any questions that come up and try and attempt to answer those. So please, I'll wait for that. And reminder too that this is general advice in only. Well, with that, without ado, let's just go straight to it and have a quick look at what's going on at the moment. This is Aussie yen that I've got on my screen at the moment, and an unwind that we rarely see before. And it's really been seen across so many of the different yen pairs. This is a daily time frame right here. But if you look across things such as dollar yen in general, another big move here back down towards this really key level of 151.95, which capped dollar yen for a large chunk of time earlier this year. My sense is that what we're looking right now is not a crisis, not an economic crisis, not a pandemic or type of scenario, but this is just really an unwind of really unsustainable, lopsided market positioning in a lot of these assets that had run really hard earlier this year. You look at what's really keeling over at this point in time. Well, US equities are underperforming now. Dollar yen, looking at what's going on. Gold today is starting to get hit as well. And a whole bunch of other high beta plays that really rocketed to kick off the start of the year. They are the ones that are getting hardest hit at this point in time. Even looking at my screen right now, I can see Bitcoin and Ether are off about 2.5% and 5% respectively. So it really gives you a sense at the moment that we're seeing an unwind of what were, up until recently, very lopsided trades. Look, given we're not looking at a crisis right now, at least not in my opinion, I question how long we're going to see this unwind last. In my opinion, this is not a GFC type scenario. This is certainly not the start of the pandemic. And they're the times that I look back to on my career when I was sitting at a trading desk, and really gave me the sense this is not that kind of moment. It doesn't feel the same. It feels like we're just seeing an unwind of these market positions. So to me, I don't think it's going to last too much longer, at least initially, until we get confirmation that, hey, we're going to go and look at a really sinister economic scenario out there. It may or may not come to fruition, but right now, it's certainly not the baseline scenario, at least in my book. A lot of other things to go and focus on as well. Is what's going on in China. And that's something that I just want to go and really kick off with right now before I look at the United States and the importance of the data on later on tonight. China, we all know the information out there at the moment. A lot of disappointment following the plenum that concluded last week. And then we've had a whole bunch of rate cuts coming through, which the policymakers did go and signal at the end of that meeting there's likely to be moves like this. But when you go and put into context what we're seeing when it comes to Chinese economic growth, and how much it's undershooting already lowered expectations, there's a few concerns out at the moment. I'll just go and pull up a quick chart to go and see what is causing some of this angst potentially. This is Citi's Economic Surprise Index. This is on Refinitiv, of course. Just want to go and get up the Chinese version of this. So for those who are not aware of this particular indicator, basically it takes the whole gambit of economic data that has come out of China, and then it aggregates it to go and give you a sense as to whether the data is net beating or coming underneath market expectations. And right now, if you talk about how pessimistic people are about China and how expectations have been lowered, you can see here Citi's index currently sits at the lowest level since the third quarter of last year, so nearly the lowest level in a year. So there's been a real deterioration in the data that's really surprised the market, and that's really getting a lot of people concerned about what's happening on that in that particular economy. And the spillover effects of that is that we're not only seeing Chinese equities hit, but we're also seeing a lot of Chinese aligned markets hit as well, and that's definitely been seen in the Aussie dollar at this point in time. I'll just go bring up this chart really quickly here. Now, I went and used this in a trade note that I released earlier this week. And it's just basically looking at the Aussie US daily chart at the top here, and you can see just how relentless this sell-off has been. It's now the longest in over a year. But what we're really looking at this point in time is clear evidence that there's basically the Aussie dollar is being used as a proxy for China right now. How can I say that? Well, have a quick look here about what's going on when it comes to the commodity markets in general, which we know that China is the world's largest commodity consumer. Copper futures, a correlation over the past fortnight on the daily time frame of 0.96, so nearly in lockstep. For crude, 0.91, so just slightly lesser. Iron ore futures out of Singapore, 0.96. So you really get the sense that those concerns about China are really flowing through to the Aussie and other Aussie crosses like Aussie yen and the like, having a big unwind at this point in time. It's really difficult to go and say how this goes and plays out in China. You have to remember that it is a command economy, and they can go and pull various levers pretty quickly when it comes to being able to go and take action. But right now, I can understand why there is anxiety out there. For a long period of time, going back decades now, all markets have come to realize is that when things get problematic in China, policymakers would go full throttle and go and offer stimulus. But we're now years into this recovery after the pandemic, and we're not seeing the same response. Indeed, a lot of concern about that property sector in particular, which is really weighing on things at this point in time. It's not just China as well that markets are getting concerned about as well. It's also the United States economy. And that's the one thing that I wanted to go and touch upon right now, because we know that the markets at this point in time still have only around about two or so, just a little bit more than two rate cuts priced this year. So there's certainly no panic when it comes to things like Fed funds futures and the short end of the US curve. But I know there's a lot of anxiety out there. Bill Dudley, I mentioned at the start, certainly giving quite a bearish scenario as to why the Fed may be already too late in cutting rates, even if it goes next week, which is definitely not being favored by markets at this point in time. Looking at the data, yes, there's been a lot of undershoots. If I go back and have a quick look at this particular economic surprise index, but we go and put it for the US instead of China. You can see here, it too is deeply negative. So net in aggregate, economic surprises are to the downside right now, and at levels they've not been seen pretty much outside of some form of crisis period on occasion. So I can understand why there is the concern there. But when you look at some of the other indicators, the latest retail sales report was pretty good. Even when you look at the control group and the like. And when you look at when it comes to economic growth, the Atlanta Fed GDP Now forecast model is predicting that the second quarter growth is going to come in around about 2.6% seasonally adjusted annualized in the second quarter. Now that's above what is deemed to be the US trend growth rate, which is good for unemployment, lowers unemployment, and it would also imply that potentially you might go and see a stabilization to a re-acceleration in inflationary pressures. And you look at things like the PMI that was released last night from S&P Global for the services, up to 56. That's not the kind of level that you'd associate with a recession at this point in time. So I think this, we're putting the other cart before the horse when it comes to these concerns about the US economy. But it's not to say that they shouldn't be there, because we're now seeing clear evidence that there is some form of deterioration. But will the Fed go and act before it takes place? Well, we'll get a really good cider on that later on this evening when we go and get the second quarter advanced GDP report. Comes with a caveat that there's lots of holes in this data. A lot of it is made of assumptions and based off what we'd seen in prior data. But it will give us the first hint as to whether there's some concern. Also paying really close attention to initial jobless claims. There's been a lot of volatility in the series over the past fortnight, and that reflects what's been happening when it comes to that July 4th public holiday, which can go and create some volatility in the data. But right now, I think we're going to get a fairly clean read as to what's going on in that trend. If you're going to see something that's really concerning in the US economy, I think it's going to show up first and foremost in that initial jobless claims print. So keep a close eye on that when it arrives at 10:30 Australian Eastern Standard Time later on this evening. Another thing I'm paying pretty close attention to right now is what's going on in the rate space, because that's going to give me confirmation whether all this chatter and all this nervousness about what's going on in the US economy really is justified. And I've seen a lot of analysis out here. Let me get to a proper chart here. So this is the US 2-10 curve. So it's getting a lot of attention again. It's a recession indicator. It's been in having longer dated yields lower than shorter dated yields, so inverted for a long period of time. And when it disinverts, it generally is the sign of a new economic cycle, either recession or renewal, depending on whether we see a hard or a soft economic landing. And right now, on a monthly time frame, is not going to give us much. But if we go and say, put it to an hourly time frame, and just see what's been going on recently, this is what's caught my eye. You can see here that it's really been steepening up. Now, when you see that, that's partly reflects what we're seeing when it comes to expectations of Fed rate cuts. The markets are moving pretty aggressively to go and price in the start of the easing cycle from the Fed, and that's flowing through to the 2-year yields. Now, at this point in time, it's still negative. It hasn't disinverted at this point. Now, I'm not concerned whether it disinverts or not. In fact, I want to go and see that, because that implies that we see firmer growth and maybe a pickup in inflation off hopefully much lower levels. But the thing you've got to go and pay attention to with this 2-10 curve, in my opinion, is not so much what's going on with the shape, but the speed at which it happens. Now, I'll just go back and have a quick look over time about this disinversion and what I'm talking about, and why you should be really closely watching this for signs that there's maybe some big economic troubles around the corner. This is going back over several decades now. And what the familiar thing you see here around economic cycles, particularly with hard economic landings, is that when it's a bad scenario, when you see unemployment lift quite dramatically and economic growth really stalls, you see a dramatic steepening in this 2-10 curve, usually a bull steepening. So you saw back here, 2001 dot-com bubble, big steepening, GFC, big steepening here. And then, of course, the pandemic that we saw, another example of that. We haven't reached that point just yet. What we want to do is see a nice measured increase in this 2-10 curve higher. Like we saw back here, you talk about the last soft landing that the Fed managed to go and engineer. Well, this is what the curve looked like back then. We saw just a modest steepening in the curve. It wasn't anything that was really aggressive at this point in time. So to me, I'm looking at this really closely, the curves in particular, as to what the markets are thinking when it comes to this economic outlook and what the Fed may do. Just touching on that really quickly, we can see here, I mentioned at the top, we've got just over 2 rate cuts. Let me go and shorten this time frame for you. So you can see here, just over 53 basis points priced into the Fed funds curve at this point in time. So markets, talking about 2 cuts, maybe the potential for 3 coming through this year, which doesn't seem unreasonable given what we're seeing with the disinflation trend, but certainly nothing there that goes and suggests that there's a panic that the Fed's going to have to slash aggressively. So this mindset we're hearing in other markets about what's going on, it's not being confirmed by me by what the bond market is doing it right now. When you want to go and zoom out and look at what expectations are, say, over the next 12 months, there's just over 25 basis point cuts being priced by the Fed funds curve. Again, nothing that tells me that there's going to be a hard economic landing. So At this point, bond traders are definitely not on board with the hard landing. They're still pretty confident we'll see a soft landing take place at this. So all this chat that we're hearing in a moment about recession risks and everything else, well, until we see the bond market confirm what we're seeing with some of the other data out there, to me, that's the way you should be handling things. That we're not going to go and see that really, really aggressive hard landing until this confirms it. Look, the other thing as well that has been getting a lot of attention naturally over the past little bit has been what's going on when it comes to US tech earnings. And I know that a lot of disappointment out there. There was a lot of high hopes for AI. And when you look at what happened with Alphabet's earnings the other night, beat almost across every single metric you could possibly imagine. But what concerns is out there is that the free cash flow and the investment in AI, there's still not that real clear evidence that it's leading to a big uplift in revenues coming through, and maybe even some cost reduction as well to go and help the bottom line. And to me, that's what I get the sense as to that was the other tell, rather than what's going on with Tesla, but more so what it was saying. That for the first time in this AI hype cycle that we're seeing, investors, markets want to go and see rubber hitting the road after the move we're seeing, because it's been so far and then we needed something to go and grab onto. And whilst Google's or Alphabet's results were pretty impressive, to me, they certainly obviously didn't go and impress the market all that much. Stocks. Let's start off with the indices. We'll go top down and we'll drill down a bit further here. And I've got a couple of the names here that are reporting next week as well. Looking here at Nasdaq E-minis, pretty clear uptrend, broken here. Next uptrend also broken. So, and also beneath the 50-day moving average. Not yet oversold on RSI. MACD is giving us a very bearish signal at this point in time. To me, certainly it looks like it's changed. You can see here coinciding with a big sell-off as well. We've seen a big spike in volumes at this point in time, and certainly no sign there, no candle, anything to go and give us a sense as to what we're going to see a turnaround anytime soon. 19,000 for me is the other next level you want to be paying pretty close attention to. And on the top side, certainly that 50-day moving average is another area to be paying pretty close attention to, given how it's been respected on so many occasions in recent times. Look, now that it's gone down the 50-day moving average, doesn't mean that we're going to go and see a sustained sell-off, but look at these supports on the downside. To me, that's the areas you want to go and pay pretty close attention to at this point in time. So certainly at this point, sell on rallies play, not buy on dips. The game has changed in that front. S&P 500 futures, slightly different story. Look, series of uptrends. Here's an uptrend dating back to when the Fed pivoted at the November last year. That's really been in place. So that to me is like the next level you want to be watching, along with that key 50-day moving average. If you look back over time, bounced, when it broke below, stayed below there, retested, then finally back through again. And if you look back over time, certainly there's been a big, it respects this level a lot, far more so than the 200-day moving average. Potentially that's because the 200 hasn't been tested all that often of late. Again, so when it comes to S&P 500, the SPOOs, yeah, that 50-day moving average and that uptrend here is going to be really key. If that goes, then we're talking about 5, 3, 6, 8, 25, and then maybe even a return back to sort of around 51.71, where it was trading only a couple of months ago. So it's rallied really hard, and now we're seeing an unwind take place. I mentioned Alphabet's earnings, certainly next week as well. You can see here just some of the declines coming through in those Mag 7 names that report next week. Apple, 2.9%. You can see here it's broken a very minor uptrend at this point, along with horizontal support at 220.21. So at this point in time, if it can't go and snap back above this level, we're talking about maybe a pullback to 206.60 at this point in time. Across all these other names as well out there, you can see Meta's another name that's going to report next week. Rejected at the 50-day moving average, and then now it's back and having a quick look, maybe in the near future at this support at 452-ish. Microsoft, another beneficiary from the AI trade through the 50-day moving average, again through horizontal support. So looking at this uptrend here, going back to earlier this year. And you can see here, that's currently kicking in around about $415 now that we've broken through there. If we can reclaim that, of course, then we start talking about 446 and 52. But again, all the momentum indicators are very bearish at this point in time. Amazon is the last of the Mag 7 names to report next week. And it too, through its 2024 uptrend, did a bit of work around it. Again, rejected the 50-day moving average. And you see here again, RSI and MACD still not saying anything about potential bounce, certainly nothing when it comes to the candlesticks to go and indicate that as well. Really quickly as well, I might just go and have a quick look at what's going on with the Aussie. I know a lot of people follow that, of course. Most of you are probably here in Australia. And just really looks horrible at the moment through the 200-day moving average. And there's not a lot to go and speak of below now until we get back towards sort of 64, 65. That 200-day moving average, it has to be reclaimed along around about 65, 80-ish, which was horizontal support that we saw earlier this year. If that can't be reclaimed, then look, the path of least resistance is lower at this point in time. It is now approaching oversold territory in RSI, but at this point in time, again, wait for a signal. There's nothing at the moment to suggest that there's going to be a near-term bounce, even though it is approaching oversold territory. Just going to finish off as well with dollar yen, because this one is going to be really important, not just for currency markets, but I think it's because it's how liquid it is and how closely followed it is, that it gives a bit of a tell as to where the path of least resistance might be for other high beta plays out there in financial markets. You can see it's just been a horror show ever since really breaking that 50-day moving average, just really, really keeled over. Lots of unwinds of carry trades taking place. And I'm looking at this area now. This is a really, really important one here. 151.95 is the area where it was capped earlier this year. The threat of intervention from the Bank of Japan bounced off that level after that intervention episode took place in late April. And you can see now it's back towards that level right now. So to me, that is the area that's really key. If you want to go and build a longer term trade idea around that zone, 151.95 and around about that 200-day moving average, just below, about 30 pips below, are the areas to go and pay really close attention to. 22 minutes. I know there's a lot going on at the moment. Look, if there's any questions that you have at this point in time, I'm just going to put up a quick disclaimer just to go and remind you that it's only general advice in nature. But if anything comes to mind right now, please shoot through any questions and I'm happy to go and cover them for you. It looks like we've not got anything at the moment, which I don't really surprise. It's quite volatile out there at this point in time. Look, just looking across our markets at this point as well, it's really interesting to see we're also witnessing gold and silver starting to get hit pretty hard right now, which to me, in a sign where it's a risk-off episode, when they start getting hit, it's a sign of capitulation. So I'll end it off right there. That when we're seeing this, again, it's one of those signs that potentially we might be nearing a bottom, but don't take my word for it. Wait for the signal from the markets. Wait for a bottoming pattern if you follow candlesticks, or wait for some really clear evidence that we've seen a bottom before you go and get excited about it. Otherwise, a lot of the moves we're seeing in these asset classes that are unwinding right now, clearly the path of least resistance is lower. Best of luck trading out there as well, and keep a close eye on that data out tonight in the United States. I think it's going to be more important than the PCE deflator, given the focus is now back on the economy and activity. Until next time, Scutty signing out.